the advantages of these weekly covered calls with ETFs is that during a bear market, you can trade covered calls on bearish ETFs. Now, the bearish ETFs increase in value as the underlying basket of stocks decline in price. And, for example, the 3 times bearish energy ETF is symbol ERY. So they also have, in addition to having the 3 times bullish energy ETF, they have the 3 times bearish energy ETF, and that seeks daily investment results before fees and expenses of 300% of the inverse of the performance of the energy select sector index. So you can also trade these bearish ETFs in bear markets, and in a bear market, you could trade covered calls on ERY and other stock ETFs, which would be in a price uptrend because they move inverse to the underlying sector. So you don't have this flexibility when you're doing stock covered calls, but with ETFs, you have this flexibility during bear markets to trade covered calls on bearish ETFs. And as I mentioned earlier, during the severe 2008 bear market, we collected $598,000 in cash payouts on bearish ETFs that were in a price uptrend. So we profited during the bear market. This is just a snapshot, a price chart of the short S&P 500 index, and this was in 2008. You can see that the short ETF was in a bull move here because it was inverse to the S&P. So this would give us a signal that we could initiate bearish covered calls when this 1-month price was above the 10-month simple moving average. Again, we collected cash payouts during the 2008 bear market, and that gives you an added dimension in your trading when you can profit in bear markets. And the bearish income trades not only reduce your portfolio risk, but also they dramatically increase your profit opportunities and provide a whole new dimension to income investing. So you can receive these cash payouts during a bear market by using inverse ETFs. And here's a snapshot. This is on September 15th. That was really the beginning of the financial Armageddon. And this snapshot on that date showed our closed trades. We closed out $14,987 in profits on September 15th, 2008. And on that day, the Dow dropped 504 points. So we had a closed trade profit that day. We also had open trade profits with inverse ETFs. So we actually profited during the bear market. So we locked in solid profits that day, and many investors considered short positions high risk, which they are if they're not done correctly. So you don't want to short a stock or you don't want to short an ETF because you incur unlimited risk if the stock or ETF moves up in price. So when you use these bearish ETFs, they're limited risk short positions, which means you can't lose more than you invest regardless of the price movement of the underlying ETF. And these covered calls on inverse ETFs allow you to profit in bear markets as the stock market declines. So that's an added dimension to your trading. Just keep that in mind for the next bear market. You can make money during a bear market. And I'm showing us snapshots now of these are just covered call portfolios over different time periods, and these open trade snapshots show we had $1,048,000 in profits, and I think we only had one losing trade in these portfolios. So these are just example of covered call portfolios, and of that $1,048,000, $847,000 of these profits were generated from weekly covered calls, and the other amount was from monthly covered calls. So there was 83 winning trades, 1 losing trade, so we had high accuracy with these covered calls. But I'll just go through these snapshots quickly. Here's a covered call portfolio for Apple, Baidu. This is the bearish energy ETF, the financial ETF, National Oil Wells Arco, the NASDAQ ETF, small cap ETF. So these are just examples of snapshots of covered call portfolios. This one had $192,000 open trade profit when we took the snapshot. This portfolio had a $323,000 profit at the time. So these are just examples of our covered call portfolios over different time frames. Okay, so we also make recommendations for weekly covered calls through our weekly option advisory. And this is a snapshot of our weekly covered call portfolio as of today. And these are all weekly covered calls. The portfolio has an average open trade profit of $243,000 and an average return of 119%. We also have a small account weekly option portfolio that has a $229,000 open trade profit and 169% return. So these are just examples of our current weekly option advisory covered call portfolios. So that concludes my presentation for today. And if you're interested in the strategies, you can log on to weeklyoptionalert.com and click trade results, and that'll show the current trade results for the various portfolios in the advisory service. Or you can call Brad toll-free at 866-661-5664 or 310-647-5664. So you can log on to the website, get an idea of how our various strategies are performing. It'll have updated trade results on the trade results page. Or you can call Brad. So that concludes my presentation, and I'd be glad to take some questions here. Let's see. Okay, it says, how much capital does a trader need for the example you present here for those covered calls? And you could, with the covered calls, you can probably do a portfolio of 4 or 5 covered calls with about $25,000, $25,000 to $30,000. So if you want to do a whole portfolio, it's going to take a little more capital because you have to buy 100 shares of the stock or the ETF. Okay, it says, does Chuck do at-the-money weekly call options or in-the-money? Now, for the option purchase, which is the first strategy we presented, we buy in-the-money call options. For the weekly covered calls, we sell to open the at-the-money call options. So those 2 strategies are different. The option purchase is in the money. The weekly covered call is we sell an at-the-money. Okay, let's see. Is it better? Here's a question. Is it better to let the stock be assigned if the stock goes down? Well, if the stock goes down and it's and at option expiration, if the stock is below the strike price, then nothing happens. You just get to keep your 100 shares of stock for a covered call. So if the stock goes down and it's below the strike price of the short call, then the short call just expires worthless, and you get to keep your 100 shares of stock in the account. If it's on option expiration, if if the stock is trading above the strike price of the short call, and you want to keep that stock in your account, then of course at that point you would close out that short call and then sell to open a new call. Okay, here's can you use the gain strategy on short positions by selling puts against the short position? And in general, we never take short positions in a stock or an option. You never want to have a short position because you face unlimited risk if the underlying stock goes up in price. So we never take short positions. The way we do a short position is a limited risk method, and that is, to buy an inverse ETF or a put option. Both of those have limited risk, and you can't lose more than you invest. But if you're actually short a stock or you're short an option that's not covered, then you do have unlimited risk, and you can lose more money than you invested. So in general, we don't take short positions. Okay, here's a question. What do you do if the ETF is up 3 or 4% on expiration? That's a good question. If the ETF is trading above the strike price of the short call, then you want to close out that short call, keep your stock, and then sell to open the new option. So if the stock goes up in price, you're going to buy to close the expiring call and sell to open the new call. And this is a really hard concept to grasp the first time, but you're going to, when you close out that short call, if the stock is up, you're going to lose money on the option, but you also own the underlying 100 shares, so that'll make up for that the loss on the option. And what you'll collect is, no matter what happens, is you'll collect the time value portion of that premium. So if you sell an at-the-money call at 2 points and the stock goes up above the strike price, you're going to lose money in the option, but that's offset by the increase in the 100 shares that you own, but you get to keep that 2 points of time premium. You always get to keep that portion of the time premium, and if you sell an at-the-money 2 point premium, then that 2 points is all time value. So you get to keep that no matter if the stock goes up or down. So it's a little hard to understand, but once you start doing these, you can roll the whole portfolio over in 15, 20 minutes a week, and once you start doing it, you understand. But to answer the question, if the stock goes up, you're still going to collect the time value portion of that option that you were short as a profit. So that's the way the covered calls work. You're always going to collect the time value portion of the option. Okay, here's a question. What happens if the stock goes up and you're called on it? Well, if you do nothing at expiration and the stock is above the strike price of the short call, you'll be automatically called, and you'll sell 100 shares at the strike price. So if you don't close out the short option before expiration, you'll be called on the stock. But it's easy to reestablish your position by simply buying another 100 shares of the ETF and selling to open the new call option. Okay, let's see. Okay. Okay, here's a question. What rule do we look for when selling a short option against a long position? If you're talking about a long position and you have 100 shares of stock and you're doing a covered call, we simply sell the at the money call. Okay, here's one. Can one find 1 to 2% returning covered call ETFs with strong bullish ETFs? Yes, with the we found that with the leveraged ETFs that you can get that 1 or 2% a week in premium by selling the at the money call. So the leveraged ETFs can easily give us 1 to 2% time premium each week by selling the at the money call. Okay. So if the stock, let's see, these questions are jumping around here. Let's see. Okay. Okay, here's a question. Do you stop losses on your option trades or just let the weekly options expire worthless? Normally with the weekly options, we don't use stop losses, but on monthly option purchases, we do use stop losses. And we'll exit a monthly call option purchase if we lose 20 to 30% on our trade. We'll exit the position. But with weekly option trades, the time period is just too short to try to time that. So, I mean, you could have a loss on a weekly trade and then, get stopped out if you use a stop, and then the next day it comes back. So it's really hard to time 1 week trade. So as a general rule, we don't use a stop loss for weekly option trades unless we have more than a 30% loss or a 30% loss, then we will exit it to prevent a large loss. So, but that's only for the first week that you're in the trade. Let's say you buy a weekly call option, you have a profit in it, you roll that profit over to the next week, and then that reduces your cost basis. So each week, if you're able to profit, then you're reducing your cost basis. Or even if you win 2 out of 3 or whatever, you're gradually reducing your cost basis, and then the stop loss doesn't really become a factor. It's only that first week you enter the trade. Yes, if you had a 20 to 30% loss in the trade that first week and you don't have any profits rolled over, then you would exit the trade to avoid a big loss. But once we established the trade, and you saw those examples, we had 4 weekly options that we had no cost basis because the profits, the rollover profits exceeded the cost basis of the new option. So in those situations, we don't use a stop loss because our cost basis is at 0. Okay, let's see. Okay, here's a question. Do you exit at the top of the channel? And this is, I'm thinking this is referring to the Keltner channels. Once we're in a trade, we use the Keltner channels to the first time we enter a trade. But after that, we don't use the Keltner channels. That's only to time our entries. If we're rolling over, as long as the stock is on a buy signal, a confirmed buy signal, then we'll go ahead and roll it over regardless of where it is on the Keltner channels, because we only use those to enter our trade for the first time, and that helps reduce your risk, your entry risk, that first time you take a trade. But once we enter and we build up some profits in the trade and reduce the cost basis of the existing new option, then we'll just simply roll it over if it's still in a price uptrend and it's still confirmed by the on-balance volume and the new 52-week high list. So we'll keep rolling over, and we only use the Keltner channels for that initial entry. Okay, here's a question, Chuck. Do you use Greeks at all for criteria for entry? We don't use the Greeks at all. The option profits, options are derivatives, and they derive their value from the underlying stock. So it's the price movement of the underlying stock that really determines whether your option is going to be profitable or not. So we simply follow the price movement of the stock. We don't pay any attention to the Greeks because we never understood how you can profit from that. I know some options are considered undervalued because of the Black-Scholes model, but those undervalued options can become more undervalued. So we never understood the value of that. We simply follow the price trend, and the price movement of the underlying stock really determines whether you're going to have a profit or not in that option. If you buy a call option, the stock goes up, you make money. If you buy a call option, the stock goes down, you lose money. So we like to keep it simple. Okay, let's see what else we have here. I think that covered most of the questions that I could see here. So I want to thank everybody for attending today. I enjoyed doing the webinar, and we'd be glad to answer any further questions if you contact our support phone number, and we'll be glad to answer any other questions. So that concludes the question and answer session for today.
Thank you very much, Chuck. That was a lot of really great information, and I'm sure everyone really learned a lot today. So I'm going to leave this event up for now so people can mull around, and if there's any thing they want to do, you can take your time leaving. And thank you, everyone, so much for being here. This event was recorded, just a reminder.
Okay, all right, great. Thanks for your help, Nick,
and
we'll see you next time.
Thanks, Chuck.
All right, have a good day.
You too.